Realty Income is down nearly 20% over the last year, and there have been many articles over the last few weeks talking about how Realty Income is a stock you need to buy like there's no tomorrow. We have articles upon articles. Realty Income is a buy for income-seeking investors. We have 3 housing stocks to play with rate cuts looming. Realty Income, as we can see, their number one stock. 2 ultra high yield financial stocks, again Realty Income being discussed there. So in today's episode we're going to take a look and see, is Realty Income now a strong undervalued buy? We're also going to take a look at the historical performance of how REITs have performed when interest rate cuts have happened. We'll just very briefly discuss the insider selling by A. Chapman. We'll take a look at the dividend safety. We'll run through dividend yield theory, take a look at the financial metrics for this company. We'll discuss the latest quarter of institutional buying and selling, and we'll run through how they've performed versus some well-known competitors over the last 5 years. We'll talk about the balance sheet very quickly, the health check of the company, total cash v total debt after their merger has been announced with Spirit Realty. And we'll take a look at their income top line as well as their bottom line for what we expect when they report earnings over the next few weeks. Now, let's take a look at this company. Don't forget, we will run them through the valuation model, getting to the intrinsic value as well as the acceptable buy price given that investor margin of safety. And we'll take a look at Wall Street to see what they are forecasting over the next 12 months. Now, I'm sure everyone is aware this stock has been hammered down, especially as those interest rates were increased over the last few years. They are trading in the mid to lower end of the 52-week range with a 5.6% yield, PFFO of 13.18. And are we now seeing a company that has reached the bottom and will go up from here into the $60, $70? Well, over the last 10 years, they are up 38%, as we can see. It doesn't include those dividends reinvested, and we do note the pre-pandemic all-time high for this company at just under $80 around 4 years ago. So let's take a very quick look. Now, they are due to report their earnings shortly, but we can see $1.3 billion reported in 2018. Remember, we look for 3 to 7% growth year on year. I just want to point out they have had consistent increases year on year up to 2022. And when we expect them to release their annual report, we are expecting an increase to $3.9 billion. So this is a company that does continue to increase their top line. We'll discuss, even more importantly than that, the growth in the P to FFO later as well. In terms of the bottom line, again, increases $364 million in 2018, $870 in 2022, and we are expecting a small increase again in December 2023. It is noted, however, that we see that this has decreased. It increased to 2018 to 19 before a decrease all the way to 2021, but it did rebound nicely into 22, and we are expecting again an increase in 23. Now, in terms of the company's health, well, always a very quick look at cash versus total debt. So cash has gone from 10 million to 344 million. Bear in mind, while we look at the total debt now, it is very common for REITs to have this total debt increase year on year. 6.5 billion in 2018, 21 billion in their latest quarterly report. So this is something that is very common, but again, when we look at that dividend safety, we will analyze those net debt to EBITDA metrics to ensure they can continue to pay. So over the last year, we're just looking at retail REITs, so Realty Income, Simon Property Group, Kimco Realty, and a few others. Taking a look at the total return over the last year, in fact, we see the industry as a whole has been negative other than Simon Property Group, up 12%. When we extend this to the last 5 years, Realty Income is up 5%. In fact, the majority are up, however, very, very minuscule. And to be honest, most of these are very small growths, and we would like to see more in any of our investments. But as always, bear in mind, past performance is never an indicator of the future. Now, we know the institutional ownership is sitting around 79%, and we note that essentially $2 billion worth of sales by these institutions have happened over the last 12 months. A lot more buying by these same institutions. But notably, in the latest quarter, we do see a lot more buying. Institutions are buying Realty Income. They do perhaps see interest rate coming in 2024, and hence why, as we're about to show, history does favor REITs when these interest rates loom. Now, very quickly, insider sales. Personally, I prefer to talk about insider buying, as I do see that as relevant. It is essentially a bullish signal. Management buy shares because they believe the company's price will go up over the foreseeable future. With insider selling, it is a little bit different, as I don't see this as a bearish signal, just given the fact that there are many reasons why insiders sell. Anyway, A. Chapman, the director, did sell around 3,500 shares in the middle of December last year at a cost of $200,000. Just important to be transparent to show you both buys and sells. So before we jump into the dividend safety, let's have a very quick look. Now, this is a very important document here. This shows us real estate investment trusts historically outperforming after the Fed tightens cycle. So these are the average returns. We can see the equity market as gray, and we see the public real estate in the dark blue. Now, what we notice during this period, we do note that the equity market does outperform the real estate. Remember, these are historical data. But as the quarters go on after this and we see those interest rate cuts, as we can see in the dark blue, quarter over quarter, real estate does significantly outperform the other markets. So something just to bear in mind. Again, this is historical data. It doesn't necessarily mean it will perform the same again, but always interesting to note, especially when we are looking at a bullish or bearish scenario either way. Now, in terms of their dividend safety, it does sit at 80. It is safe. 39 billion market cap, large cap company. When we take a look at the key recessionary metrics, well, they increased the dividend during the last recession. Average growth pretty much negative 1% versus the S&P's negative 12%. Recession return negative 43%, outperforming the S&P recession return of negative 55%. Dividend growth, so it was in line with inflation for the last full year. Over the last 5 years, 3%, slightly lower. Remember, we're looking for 4% as a bare minimum because the US inflation rate over the last 40 years was 4%. If you're getting less than that in your dividends, your salary, or your other income producing assets, you are taking a pay cut and losing your purchasing power. So it is nice to note a little bit higher than inflationary increase on average over the last 20 years. And they are also a dividend aristocrat. They have increased those dividends for the last 25 years or more. In terms of undervaluation, well, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. 5.68 versus 4.41, so we do have our first sign of undervaluation. Forward P to FFO 13.1 versus 17.9, another big sign of undervaluation. And we see the real estate sector P to FFO slightly higher at 13.7. Now, regular viewers know we do tend to focus on the free cash flow as earnings data is susceptible to manipulation by management through accounting. However, for REITs, we focus on the adjusted funds from operation as the free cash flow is a lot more volatile for REITs. So in terms of the payout, below 90% is what we like to see. For Realty Income, nice to see it's at 90% in 2013. Since that point, it has been coming down year on year. 76 in 22, 76% expected in 2023. In terms of the adjusted funds from operation per share, nice consistent increases year on year. 2023 expected $4 when the annual report comes out soon. $4.14 targeted in 2024. Now, when we take a look at the sales growth, as always for REITs, we look for steady, moderate growth, 5 to 10%. Nice to see that, especially over the last 3 years, some strong growth. But what's also important to see for REITs is the adjusted funds from operation per share growth. Nice to see that it is very, very consistent over the longer term. 3%, however, expected in 2023, 4% in 2024. And it'll be nice to see these numbers, especially when we get a full year of that Spirit Realty acquisition in the numbers. Now, here it is to see the numericals in terms of the top line. 780 million in 2013, 3.9 billion expected in 2023. Now, one thing I always point out, which is especially important for new viewers or people who are new to REITs, real estate investment trusts, they do typically dilute your position significantly over the longer term. 192 million in 2013, 670 from the latest report. The reason for this is they do retain a little of that internally generated cash flow after paying dividends. So this is one way how they can increase those capital over the longer term. ROIC for REITs, 3 to 5%. The reason I do this metric, it gives me faith management are able to effectively allocate their capital. For other companies, 10% or more. Now, when we take a look at the margins, nice to note the high 40s consistently. It did dip in 2022. It is expected to come up in 2023 to 41%. So that is positive, especially as it has been consistently in the 40s year on year. Now, this is one of the most important metrics, is the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. 5.5 is the maximum, and what this shows, the number of years it would take the company to pay off all of their debt net of cash on hand. Why it's so important, it shows us the dividend safety as well as the balance sheet strength. 2023, 5.97 expected. It is higher than the 5.5 that we like to see. The positive is that in 2023, it is expected to go down to 4.65. So that is nice to note that it is expecting to reduce their debt. Now let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we run through all the models. The first one would be Graham's valuation. However, for REITs, this isn't applicable. So let's jump into the first model, the relevant multiples valuation model. So we have companies in a similar sector and size, ADC, FRT, Kim, and Simon Property. We have their P to FFO multiple, that average, and as well we can see that of O, to give an intrinsic value of $66. So we have our first sign of undervaluation. Bear in mind though, we're not looking at any of these models in isolation. We then have the dividend discount model with the average dividend around 3.2% over the longer term. Moving forwards, I have gone for 3.25. I am expecting them over time to be increasing those dividends at least in line with inflation at 4%. So I would say this is a bit more conservative. This gives an intrinsic value of $67. Now we can see the market value, so it is much higher. So we do see another sign of undervaluation. We then move on to the DCF model with the free cash flows year on year. Average growth of 22%. Forward looking, we've gone lower than analyst estimates and the average to be more conservative again. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we see our third signal of undervaluation. So then the intrinsic value for today's episode comes to a grand total of $66. Now the current price at $54.97, a lot of people will argue they are waiting for this to go lower. A lot of people may also believe it has hit the bottom. The way we typically use is a margin of safety. 10% is what we go for if we believe it has a wide moat, strong financial metrics, good forward-looking data. At 15%, it is still a buy up to 50. At 20%, it is a buy around $52.85. Now, my personal preference is to buy this at least around a 20% margin of safety of $52 or thereabouts. A lot of people may even want to go at 25% at just under $50. Right now, however, we do see around 15 to 20% margin of safety. Personally, for me, this is one I do already hold in my portfolio. I did add 1 or 2 shares just last week, and I am waiting for this to come down to that $52 mark before buying a lot more to increase the position in the portfolio. Do let me know your thoughts in the comments below, though. Are you looking to buy more Realty Income right now, or are you also waiting for a lower price around that $52 or maybe sub $50 mark? In terms of Wall Street, well, they see an upside of 14%, a price target of $63, so they do believe this to be a strong buy, especially amongst those dividend income investors who like that monthly dividend. As always, if you enjoyed today's episode, smash the like button. If you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or those on your watch list, do click on that pinned comment below. As always, have a great day. See you on the next episode and take care for now.